Yo, here we are again, Self-Funded Sketchbook. This time we're going to cover the attachment point. I'm trying to make these somewhat episodic and build on one another, so if you haven't watched my specific stop loss video and my aggregate stop loss video, then don't watch the attachment point video just yet, because you'll want to understand those things before you understand this. This is one of the more complex things you need to understand as it pertains to stop loss, and if you're going to understand self-funding, and if you're budgeting or projecting dollars for future spend, an attachment point understanding is going to be integral for you, okay? So let's dig in. All right, one of my very favorite subjects, the attachment point. Guys, if you're digging into this video and you haven't first watched my videos on specific stop loss insurance and aggregate stop loss insurance, I'm going to link those below. I want to make sure you stop here and go watch those first before you come back to this particular video, because you'll be lacking some context. Okay, so what are we seeing on here? We have a few lines and we have some really bad handwriting. But ultimately what an attachment point is again referencing back to the aggregate stop loss video, this is the maximum amount of small claims an employer will pay in a given policy year before a stop loss carrier is obligated to reimbursement. So how do we get to an attachment point? So ultimately what a stop loss carrier will do is they will look at historical claims, they will look at the census, they'll build basically a model in their mind of what ultimately will likely be the total expected claims for the year. So let's say that was $1 million, right? What that stop loss carrier would then do is then add a corridor or a buffer on top of the expected number called the attachment point. The typical expected plus corridor of 25% means that I will add 25% above whatever I calculated as expected, and that's how I'm going to set my attachment point. Another way to think of this is the attachment point is a function of expected claims. Now I say a typical corridor. Kind of the industry standard is 25%. Sometimes the corridor may be 20%, maybe even as low as 110% or 10% above expected in a level funded plan. No matter what this is doing is taking that risk profile, adding margin of error for the stop loss carrier, and then capping the risk at this attachment point number. I drew this visual with a third line because ultimately neither one of these are going to be right. Expected claims is just a projection. Attachment point is a function of that projection. Ultimately, the actual claims will be somewhere above, below, in between. We just don't know. And so in this instance, I've drawn a curve of what it'll look like for the year to actually start happening for that employer and as those claims accumulate. So in this scenario, we ended actual claims above expected a little bit, but below my attachment point. The reason I drew the curve like this is I'm assuming this is a fully insured group that's coming off a fully insured plan. And so ultimately there's going to be some lag in claims. And so really only in about month 3 or 4, you're going to start seeing those dollars start to accumulate more. Let's say though, this actual claims dollar was above here. So at the end of the policy period, and if there's any run out, at the end of a period of time, the stop loss carrier will go, okay, is this actual claims in a position above the attachment point? And if the answer is yes, if and when that is the case, they will reimburse that employer for anything above. Now there is something called aggregate accommodation, which I can explain in a later video, which would actually cap an employer's risk on a monthly basis. It's also typically built into a level funded plan. But in this particular look, all we're doing is saying what happened in this plan year, and if at the end of the year am I above that attachment point, then that's the only time I will receive reimbursement. This maybe on average happens between 1 to 3% of the time. This is a very low likelihood outcome because that margin of error of 25% typically is pretty big wiggle room for that underwriter to be correct. And so that's another reason why visually, I told you in the previous video, very small amount of premium overall, because this is a very predictable thing. Also, because a stop loss specific deductible exists, there's a lot less variability because we're only talking about the risk underneath that specific deductible. Okay guys, this is a lot to learn. You may want to watch this video a couple times. I'm sure there might be some comments and questions that I can answer below, but ultimately this is your first look at what the attachment point is, how it's worked, or how it works and how it's calculated. Thanks for watching, guys.